China, China, China. I think that's the sort of chorus out there. The Chinese markets are up 4% right now. As we speak, Hang Seng is up a little less, but it's up and has been, from the lows of September, quite a remarkable 25% kind of a move that we've seen. We've got Andrew Tilton, a Chief Asia Pacific Economist at Goldman Sachs, joining us. Andrew, great to have you with us here on the program. Thanks for your time. Prashant, this side. Andrew, is this a big tactical move? We've had at least two of these since 2020, which eventually does not go anywhere. But when you're in it, it feels like the real thing. 40, 50% kind of moves from the lows. Are we in the midst of one of those, or do you think this time it's different?
Sure looks that way. We've seen a big shift in Chinese macro policy over the last week. Investors have been waiting for quite some time for signs that policymakers would take more decisive actions to stem the housing downturn and try to stabilize growth. Last week, we had a PBOC announcement with a bunch of monetary policy easing measures, and then a Politburo meeting indicating the willingness to deploy more fiscal stimulus. So those are very important signals that I think markets have been waiting for a long time.
Hi, Andrew. Morning, and good to see you, Ben. But do you think the Chinese authorities have done enough? Because in the past we have seen the announcement come about, the excitement as well, heats up. But ultimately, it fades away. But this time, do you believe they've done enough?
We know a lot about the monetary stimulus. We've eased policy rates 20 basis points, cut reserve requirements half a point, taken some measures to boost the equity market as well as housing. What we don't know as much about yet is the fiscal stimulus. There have been various media articles suggesting potentially bank recapitalization, consumer-related stimulus, but the details of those fiscal measures are not yet available. So I think it's too early to say they've done enough. We'd likely need fiscal stimulus in the trillions of renminbi to really move the needle in a significant way on the Chinese economy. There are big structural challenges, a multi-year housing downturn, cautious attitude from both consumers and businesses. And so to turn that around and really improve the growth outlook for 2025, we're going to need to see a big dose of fiscal stimulus, and we're still awaiting the details of that.
So, Andrew, we have major moves happening in two large economies, right? There's China on one hand. Tell us, to sum it all, whether you think this will really move the needle. We just had the latest official PMI numbers out this morning. They're not as bad as what we've seen earlier this year. So all things put together, where does it leave China? Is it getting out of the funk? And then there's Japan, where there's leadership change, where there's a question mark on whether BOJ will keep hiking, whether they'll pause because the Fed is cutting. What should we expect from Japan over the next 6 months?
Well, these two countries are really going in very different directions with regard to policy. Japan is tightening, albeit slowly, and from a very easy level, tightening monetary policy and potentially fiscal policy with the new PM, talking about potential tax changes. Whereas China is going the other direction, easing monetary policy, potentially easing fiscal policy quite significantly. And I think you've seen the equity markets respond accordingly, with Japan down, China up. But the bigger lens I'd put on all this is we are seeing an opening up of space for a lot of central banks around the world to cut rates. The Fed has begun cutting with a 50 basis point move in mid-September. A lot of emerging market central banks that were on the fence, maybe waiting to think about cutting rates, are now feeling more free to do so. The U.S. dollar has weakened. Those capital outflow pressures, particularly from China, have eased, and that's opened up policy space. So you remove some of those constraints on policymakers, and in a place like China, where growth data have really been disappointing, that provides a better backdrop for policy easing, which is what we're beginning to see.
Andrew, you said, right, it's not monetary. It's exactly what they do on the fiscal side which will matter. And there was a Reuters article which essentially said that they're planning to, in dollar terms, about $120 odd dollars per child, per household. I mean, something like that. That's essentially what they said. Direct money, cash transfers is what that article suggested. Is that going to be? Is that what is going to be needed for markets to remain excited? I mean, real economy we'll get to when it happens, but what will it take for markets to continue to do well?
That will be a shift from what we've typically seen Chinese policymakers do in the past. Typically, they've used fiscal stimulus to support infrastructure spending, government priorities, sometimes trade-in allowances to encourage households to move up to more green or newer appliances and cars. Direct cash transfers have typically only been done in very small size. So a larger scale cash transfer would be a signal that policymakers see the concern around the economy and are willing to do more. Just to put it in perspective, we think the monetary easing measures taken last week would be worth a bit less than a half point on Chinese growth. Now, 1 trillion renminbi, which I think is the stimulus to which you're referring, on the consumer side, if that were implemented, that adds up to 80 basis points, so 0.8 of a point of Chinese GDP. Not all that money would necessarily be spent, but again, you could be talking about an impact on the order of potentially half a point of Chinese GDP. There are other tailwinds. The housing market continues to slide, and exports, which have been very strong over the past year, probably won't be quite as strong in 2025. So there are a lot of moving parts, but as the external side of the economy, which has really been supporting growth, starts to fade, policymakers will need to do more to support domestic demand, particularly consumption.
All right, Andrew, we'll leave it there. Thank you very much for your time. And I hope that we can sort of, you'll come back and we can sort of track this progress and what's happening in China with you on a regular basis. We'd love to do that. Thank you for joining us here on CNBC TV 18.